Live from New York City this morning. Good morning, good morning. Your equity market slightly negative here. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York coming up. More Fed officials putting rate hikes on ice as Asia pushes back against dollar strength, and crude sitting near the highs of the year. We begin with the big issue, a new challenge to a soft landing.
When you look at the broad commodity market,
commodity prices are rising.
Higher oil prices, the spike in oil prices and gas prices.
Crude oil and gasoline prices might be a market-based measure of economic demand, and right now they're both very strong.
That tends to be something to follow as a catalyst into where you start to see inflation numbers tick up.
Pressure on inflation.
The last thing consumers need at this point in time.
It really does look like year-over-year inflation bottomed at 3% in June, and it's going to probably start drifting towards 4%.
You probably saw the two weakest prints you're going to see this year over the summer.
If we are seeing higher commodity prices, eventually that should translate into higher yields.
We're going to see higher yields for a little bit longer.
The reality is that it's very, very difficult to achieve a soft landing.
There's so many wrinkles right now.
There's definitely some fraying around the edges.
Bad news might wind up becoming bad news as we move forward from here.
Crude very close to 90 in the last 24 hours, a break at that level for the first time since November. Joining us to discuss, Stifel's Barry Bannister, Richard Bernstein of RB Advisors. Barry, your words, you say new highs in stocks, exceptionally unlikely. Barry, can you give us the why?
Yeah, if you look at the broader stock market, the valuation is very high. The price-earnings ratio, the way we calculate it, versus the financial conditions index is high. The stock-to-bond ratio looks high to us. And the earnings estimates for 2024, the street, 9% earnings growth. Our model comes up with about half that level of growth, about 4.5%. So overall, we've had a great run through mid-2023. We've been saying since the summer that the stock market would be flat in the second half as it digests the recent gains, and we have some uncertainty looking forward.
Richard Bernstein, do you still believe the outlook for profits is actually bottoming here?
I do, John. Our data, our models actually are suggesting that we're starting to look at profits reaccelerating, which I think is very important, and very important for something that you didn't even mention in the preamble here, was that the labor market is still pretty tight despite a profits recession. Now we're going to see profits start accelerating. Corporations usually hire as profits start accelerating. So I think to expect the labor market to start easing when profits are reaccelerating may not be the right tack to take here.
Barry, what's Richard getting wrong?
Well, if you look at, for instance, technology, where our earnings estimate is below the street by a more significant margin, earnings are a lagged effect of the slowdown we've already had. In other words, the durable goods, the factory orders, the PMI indices, they all slowed down in 23. And what you find is there's a lagged effect. And we've gone back 30, 35 years historically, best fit. There's a lagged effect to the economic variables. So we have to be cognizant that we have seen a fairly significant slowdown in some of the cyclical economic data that will filter through at least through the first half of 24. And getting through the first half of 24 is a very long time to wait to be right about a reacceleration.
So, Richard, where are you seeing that reacceleration in profits right now? Where are you expecting to see that in this equity market?
Well, it's already happening, John. I mean, this is not something we have to wait for. It's already happening. Profits growth is troughing. And in the United States, profits growth is troughing in many parts of the world. I mean, I don't think people realize that European earnings are growing faster than the U.S. technology sector's earnings. So, you know, I don't think we have to wait for this. It's already happening.
So, Richard, the small caps, international, what's the bias for you?
Right. So, John, I may sound like a broken record here. I still view the equity markets as being like a seesaw. And on one side of the seesaw, we've got tech, we've got all the sexy stuff on one side. And on the other side of the seesaw, we have everything else in the world. And so our firm is squarely planted on the everything else in the world side of that seesaw. And small caps are clearly playing a role in that. I mean, all you have to do is look at the relative price between the NASDAQ 100 and the Russell 2000. I mean, it's an historic gap. But yet earnings growth is starting to trough, which usually favors lower quality and smaller companies.
I wanted to pick out a quote that you'd put in your research, Richard. The quote reads as follows. I'll share it with our audience. The performance of the Magnificent Seven versus the Russell 2000 continues to stretch. We should all hope this doesn't continue because the implications for the U.S. economy are dire. Now, is that hope or a strategy? Richard, which one is it?
No, I think that's actually what history would suggest. John, when profits growth troughs, markets become very Darwinistic. It becomes survival of the fittest. And so that's why you get broad leadership at the beginning of a cycle, narrow leadership at the end of the cycle, because more and more companies fall by the wayside as the cycle matures and they can't keep up their earnings growth. If you believe that there are only 7 growth stories in the entire world, that is an amazingly dire economic forecast. So my argument is that we should all hope that the Magnificent Seven underperform, because if they do perform, and if that's correct, let's say it's not a bubble, I kind of think it's a little very speculative, but let's assume it's not a bubble and it is fundamentally based. That is a tremendously dire forecast of the future. We just can't believe that the global economy is in that shape, that there's only going to be 7 growth companies in the entire world.
Barry, do you hope the Magnificent Seven will underperform, or do you think the Magnificent Seven will underperform?
Look, the cyclical growth, which includes the big retail, the Tesla, as well as all the big tech, is about half the market, 45%, if you just take all of cyclical growth within the S&P industries. So if they underperform, the market's not going anywhere. And, you know, what I have to do is predict not only the market level and direction, but the winners within the industries. And for the sake of argument, let's say we are reaccelerating in a very significant way. The real 10-year TIPS yield should be well north of 2. It was 2.5 before the financial crisis, 3.5 before the tech bubble burst. So let's say it's 2.5. If you overlay the price of oil, Brent oil, against the 10-year break-evens, it should be 2.5. So what are you looking at? 5% on the Treasury yields. We're not going to maintain a 21 forward multiple of earnings at a 5% nominal Treasury yield. So the point is, the stock market is a financial instrument. If you're going to talk about very bullish outlooks for economic growth, you're also going to have a lower multiple for it.
Richard, what would you say back to that?
So I don't disagree with what Barry just said. I think the market overall is on the expensive side for sure. There's no doubt about that. But I think I have to remember, Barry said this, that what's important is the construction of the market. You know, in the first half of the year, the Magnificent Seven contributed about 70 to 75% of market performance. So if you're saying the market's overvalued, if you're saying the market's going down, one's implicitly arguing my seesaw combination here that the Magnificent Seven underperform and other parts of the market are likely to outperform, with the fulcrum of the seesaw, kind of what Barry's referring to, basically doing nothing. And I think that's a fair assessment.
Richard, away from stocks, developments in the bond market, yields up again over the last couple of days. We'll talk about some of the corporate issuance in the credit market a little bit later this morning with Amanda Landon at Goldman. We'll do that about 9:35 Eastern time. But yields up, driven in some part also by this move in the crude market. Big rally for WTI, 20% move since middle of July. Richard, we've seen a couple of airlines, 3 of them actually this morning, United, Southwest, Alaska, all talk up higher fuel costs. The conversation we had on the program a little bit earlier this morning is whether these airlines need to eat that or whether they can actually pass that on. Are you confident they can pass some of this on?
I think they're going to try, for sure. I think that's what most corporations do at the beginning. But John, I think your opening statement, the preamble here, was really important because it started with saying the Fed's on ice, but then it was all about commodity prices. I think if we ever needed to understand that the Fed is a lagging indicator, your preamble said it perfectly, that the Fed is thinking it's time to pause as commodity prices are starting to go up and companies are going to try to pass that along. I think that's a perfect example of why the Fed has always been a lagging indicator.
Well, there's some real tension here, Richard, isn't there? The Federal Reserve potentially rate hikes on ice in September. At the same time, you're seeing iron ore at the highs we haven't seen for about 4 months, crude at the highs we haven't seen since November. All of this is happening as China seems to be slowing down. Can you make sense of that for me, Richard?
Well, I think, John, I think we've got to be a little careful on jumping on the China stinks bandwagon. You know, I think that we're kind of looking at a situation where the government there, both the central bank and the fiscal side, is not giving up the stimulus battle. And so, in the United States, we would always say, don't fight the Fed. I think one wants to be a little careful from an investment point of view to say you don't want to fight the PBOC and the Chinese Central Command or whatever, however you want to phrase it. So I think we want to be a little careful. Their economy is not falling off a cliff. It has been stumbling. It's disappointing. But, their economy is going to reaccelerate.
You mentioned the Federal Reserve. I hear Mike McKee. So let's get to Mike McKee. Mike McKee, are rate hikes on ice this month?
It's beginning to look that way. A lot of members of the Open Market Committee have suggested they could take a pause. But heck, we went to the mountains, we went to the beach this summer, and we kicked the can down the road on a lot of possible problems for the economy ahead, one of which you've been talking about a lot this morning, oil prices. You were talking about jet fuel, but what does it mean for gasoline and consumer confidence? The stronger dollar, it keeps getting stronger, which means probably we have fewer exports, but we also have lower inflation. Stronger U.S. growth. We were talking about an over 5 handle on the Atlanta Fed GDP now. Some people are saying that's ridiculous. We probably won't get more than 3. 3% would be 3 times what perhaps the potential growth is right now. Some problems solve themselves. All things China. We're going to be looking to see, and you've been talking about it on this show already, what happens with the Chinese economy and what impact that has around the world. Government shutdown. There's a self-inflicted wound coming up at the end of the month, it appears. And then labor unrest next week. Same day we get CPI, we get word on whether the UAW will send 150,000 workers out on strike, which will also shut down suppliers and things like that. So a lot to worry about, or not. Here's the gasoline price situation. Everybody's going to be talking about the impact of these higher oil prices on gasoline, but take a look. Gasoline prices are going down, even as oil prices are going up. It's that time of year when demand is slower. We've got all those refineries that were out back in service pretty much. So where do gasoline prices go? We don't know. Makes it very difficult for the Fed. Now, for September, they're kind of putting things on hold. But November, well, we heard from Susan Collins this morning. She said patience will give us time to better separate signal from noise as we assess available data. And I'm going to quote the eminent physicist Niels Bohr, who once said, prediction is very difficult, especially if it's about the future.
Well, Niels Bohr nailed it, didn't he? Mike McKee, thank you, buddy. As always, Mike McKee there on the Federal Reserve. Barry Bannister, Richard Bernstein are going to be sticking with us. Your equity market on the S&P 500 here, negative by 0.2%. I'm happy to say we can get you some movers going into the opening bell. Here's Abby.
Indeed, John, and we are looking at the possibility of a second down day in a row. Mild losses right now for the S&P 500 and the Nasdaq ahead of the open, but one stock that is soaring going against that grain, Roku. These shares are up more than 10% the last time I took a look, given the fact that they are planning on cutting 10% of their workforce. They're consolidating some office space and excluding the charges for those restructuring moves. Roku raised its third quarter revenue guidance by as much as 7%. So investors excited about that. Block, on the other hand, down 2.7%. UBS has cut the shares to a neutral from a buy on a potential slowdown in gross margin profit growth. And John, they're talking about a softening consumer discretionary spend going forward. You were mentioning those airlines. Well, Southwest Airlines in some ways confirmed that, saying that they have seen some luxury travel down in the month of August. Apparently, the Labor Day weekend was strong, but those high rising fuel costs, well, what is that going to mean for the airlines? We'll be exploring that more after the bell.
Looking forward to that conversation in about 17 minutes' time. Abby, thanks for that. Equities a little bit lower then, down by 0.25% on the S&P 500. In the bond market, yields pretty much unchanged on a 10-year over the previous 2 sessions, a 16 basis point move Friday and Tuesday. A curious move. Was that all about credit supply? We'll have that conversation with Amanda Lynham of BlackRock a little bit later this morning. In the FX market, the euro right now slightly positive at 107.31, positive there by 0.1%. The story, though, over the last 8 weeks, dollar strength. Coming up, Asia pushing back against a surging US dollar.
They're really fighting a strong dollar above all else. So they don't really have control over the big dollar story. They do have some control over the yen. If they really want to strengthen the yen, then they do have the tools now. They don't really want the exchange rate to be another source of instability.
Japan pushing back with some verbal intervention. China pushing back as well. That conversation up next.
they're really fighting a strong dollar above all else. So they don't really have control over the big dollar story. They do have some control over the yen. If they really want to strengthen the yen, then they do have the tools now. The Chinese authorities have the capacity to manage some weakness. I don't think they need to be too afraid that all of a sudden the yuan is going to drop precipitously.
The US dollar heading towards an 8th consecutive weekly gain, sending Asian currencies to multi-month lows and prompting authorities there to push back with threats of intervention. Japan issuing its strongest warning in weeks, saying the nation is ready to take action amid speculative market moves. And in China, the PBOC escalating its defense with a record one daily fixing. Bloomberg's Ender Curran joins us now for more. Ender, I mentioned this a little bit earlier. Talk is cheap. Is that talk going to work?
Well, the problem for the authorities in Asia, John, is that this is not a story about the yuan or about the yen. It's all about the US dollar. And as you know well, the conversation here is that the Fed may not yet be done hiking, and even if they are, interest rates are probably going to stay high for a while, and that's what's driving the dollar higher. So it's well outside of the control of what's happening in Asia. The yuan fell to the 2007 low that you mentioned. You might on paper say that's because of the China slowdown, but as I'm saying, it's as much a dollar story as anything else. And of course, over in Tokyo, the authorities there warning against speculative moves that they might have to step into the market, but they're going to have to step in, of course, against the Fed freight train. But it is another example of how the Fed's hiking cycle and the dollar is causing pain around the world, and surely it will add further fuel to the campaign that's led by China and other nations that want to diversify away from dollar usage.
And out of interest, what are they worried about? Because Japan are telling us they want to reset inflation expectations higher. Surely a weaker currency helps that. China's going through some economic difficulty. We spoke to a lot of guests, including Alan Ruskin this morning at Deutsche Bank, about the potential of actually a weaker currency helping them. What don't they like?
Well, a weaker currency, there's a question of diminishing returns when it comes to, trade and exports, when demand for trade and exports is already weak, John. I think that's part of the thinking there. But also, I think it's more about volatility and the pace of the drop or the pace of the decline. Certainly, Japan has always leaned against large gappy type moves in the yen. And on the Chinese side, of course, they don't want the yuan falling at a pace that might trigger or pressure companies and households to try and get their money out of China. Remember the whole capital outflow story that we experienced back in 2015. So I think on the one side is a debate of diminishing returns when it comes to what kind of lift you get for trade, but on the other side, it's the danger from too much volatility in your currency market.
And a current down in Washington, D.C. on top of the story, pushback from China, pushback from Japan. Back with us for a final word, Barry Bannister, Richard Bernstein. Barry, we need to talk about the other side of the trade. 8 weeks of gains for the dollar. Longest weekly winning streak potentially going back to 2014. I remember those conversations 10 years ago, Barry. We used to talk about it. Is that strong dollar good or bad for the S&P 500? Barry, is it good or bad?
Well, typically a strong dollar is disinflationary, and so it's good for the tech stocks. But in this case, the Fed is really doing a pretty good job of breaking the world. The Chinese are pretty close to deflation. So in what you call real effective exchange rate terms, the yuan nominal and real seem to be going in different directions. The Japanese are having to repress their currency. And so the Fed is, with its rate differential, keeping the dollar aloft. It would be, I think, favorable, though, if we get some relief on inflation, for the Fed to back off a little bit and for the dollar to come down. I think it would be a positive, of course, for earnings, but for other things as well.
Richard, would you agree?
So, John, I think the most interesting thing is the first half we were talking about commodity prices, and the second half here we're talking about an appreciating dollar. Normally, when the dollar appreciates, commodity prices go down. This time we're talking about commodity prices going up at the same time you have an appreciating dollar. That says somebody out there is demanding commodities, that the price increase of commodities is not curtailing demand. And the price is still going up despite a stronger dollar. So I think overall it suggests that people shouldn't think that the global economy is falling apart here. Somebody out there is demanding commodities, whether it's China, whether it's who knows who, but somebody out there is demanding commodities, and the appreciation of the dollar isn't stopping it so far.
If it was just crude, I'd say, Richard, maybe it's just a supply story, Russia, Saudi, but it's not just crude. To your point, it's also iron ore as well. So,
Correct.
Richard, with all of that in mind, final word. Let's put some money to work. If the international story is not as bad as people say it is, and you're indicating it might not be, where do you want to put that money to work right now? Where specifically, country, sector, index? Pick whichever one you like.
So, John, we have our lowest weight in the United States we've had in the history of our firm. We're overweight Europe, as I mentioned before. European earnings growth is surpassing that of the U.S. tech sector, and that's expected to continue as we go into 2024. Japan, the weak yen is an interesting story. We'll see if that continues, given some of the discussion we've just had. But that's critical in terms of the Japanese story. Even China, with the amount of fiscal stimulus they've had. I mentioned small caps before in the United States. We think that's interesting as well. It's basically everything outside the sexy stuff on the one side of my seesaw.
Richard Bernstein, Barry Bannister, to the two of you, I've enjoyed the last 20 minutes. Thanks for being with us. Appreciate it. 8 minutes away from the opening bell. Equity futures here trying to stage a recovery. Just a little bounce off the low. We're still down here by 0.2%. Coming up, the morning calls, and later, September kicking off with an onslaught of new debt supply. That conversation still ahead with BlackRock's Amanda Lynham. Live from New York City this morning. Good morning. Your opening bell, 7 minutes away. Just a little bit of weakness to start the week. We're about 7 or 8 minutes away from the opening bell. Call it 5 now, actually. Equity futures pulling back just a touch on the S&P 500, down by, let's call it 0.2%. In the bond market, some big moves again. 2 sessions, Friday, Tuesday, 16 basis points higher on a 10-year yield. The 10-year right now at about 425.19, pulling back just a touch. How much of this move was about corporate credit supply? We'll have that conversation in about 10 minutes' time. How much of this move was about this right here, crude? WTI and Brent. WTI, 8-day rally at the close yesterday, the longest daily winning streak going back to January of this year. The overall price through 90 briefly on Brent for the first time since November. Across the board here, still near close to highs for the year. The dollar is just about negative, but the crude price is the one I want to focus on. Brent and WTI. Brent at about 89.72, WTI at about 86.50. That's the price action. Let's get you some morning calls. First up, UBS downgrading block to neutral, seeing limited upside as growth decelerates due to a softening consumer. Your second call from Morgan Stanley upgrading First Solar to equal weight, saying that shares deserve a premium. Given the lack of downside risk, that stock is positive by 1.8%. And finally, TD Cowen upgrading Constellation Brands to outperform, expecting the company's analyst meeting to serve as an upside catalyst. That stock is up by 1.7%. Coming up, debt issuers storming the market with a post-Labor Day bond blitz. That conversation up next with BlackRock's Amanda Lynham. Your opening bell just around the corner. 23 seconds away from the opening bell here this morning. Good morning to you all. Equities pulling back just a touch. No real drama here throughout much of this morning. We're down about 0.2% on the S&P, on the Nasdaq down about 0.25%. Plenty of disruption in the last 24 hours in the bond market, one, and in the commodity market too. We'll talk about that now. Switch at the board. There is your opening bell. Get to the bond market. Yields look like this, lower by a couple of basis points on a 10-year, 424 over the previous 2 sessions, 16 basis points higher. Friday, Tuesday, of course, closed on Monday. And that move, is that about supply coming out of the credit market or about this move in crude? 86.43 on WTI, negative here by 1/3%, but an 8-day rally on crude that we need to talk about a whole lot more over the next couple of days. In the FX market, the euro showing a bit of strength. The data out of Germany, ugly, but some hawks, 2 actually, going into the ECB a week tomorrow, flagging maybe the potential for an interest rate hike in September, just reintroducing just a little bit more two-way risk into that ECB meeting in Frankfurt, Germany. About 40 seconds into the session, we look like this. Equities right now on the S&P negative by 1/3%. On the Nasdaq, we're down about 1/3% also. One sector to watch at the open, the airlines sounding the alarm on higher fuel costs due to surging crude prices. Southwest cutting its Q3 outlook right in this. August bookings were on the lower end of the company's expectations, modestly impacted by seasonal trends. Abby has more more. Hey, Abby.
Hey, John. And you can see that Southwest Airlines down more so than United Airlines and Alaska, down more than 1%. In fact, down for a fourth day in a row over that time period, Southwest Airlines falling about 5%. So this filing that came out may not be a surprise to everybody. They also talked about the fact that they saw a weaker leisure travel in the month of August. To be fair, Labor Day better. They are expecting better trends as the year goes on, or solid trends. But this rising fuel issue, oil, WTI crude, up more than 35% from its low earlier this year. That really pressing into jet fuel. So these three airlines highlighting the fact that that could really crimp their profits going ahead. Now, they have not actually adjusted numbers in that fact, except for, of course, Southwest Airlines, as you just talked about. They did tighten their revenue range. Now, it's really interesting. Southwest Airlines, because of the issues last December, I think we have to discount a little bit. On the year, it's down more than 10%. United Airlines up more than 28%. But the group as a whole, John, this is really interesting. It's a classic inverse relationship between the airlines and that big cost component, oil. For the year into the peak back in July, up more than 43%, now down 30% from that as WTI crude and Brent crude oil has gone higher. And right about now, even the airlines up about 10% on the year. Crude oil up just a little bit more, up 14%. It seems that the balance is tipping in the direction of commodities, despite that dollar strength.
Abby, thank you. Southwest right now down a little more than 2%. A note on the airlines from Bank of America, remaining cautious on the airline sector, writing the following. Commodity prices have created meaningful earnings volatility this year. Pricing power could weaken as the recovery normalizes and capacity comes back online. As a result, our new earnings estimates result in lower price objectives across the group here. This is a call across the group for the entire airline sector. The latest there from Bank of America. I want to turn to big tech. Shares of Apple under pressure. Chinese government agencies have banned staff from using iPhones at work, according to the Wall Street Journal. It isn't clear how widely the orders were issued. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. Apple is softer by 0.6%. The Wall Street Journal reporting that some central agencies in China have issued directives via chat rooms and in meetings that they should replace their mobile device in the event it is a foreign device, not just an Apple iPhone, but a non-domestic device. I would say, remember that Bloomberg reported in May of last year that Beijing offered a 2-year deadline or term limit for state corporations and indeed government agencies to swap out their foreign brand personal computers for a domestic brand. So this is not necessarily an unprecedented move. Apple now soft at 0.8%. Apple have not responded to a request for comment from Bloomberg News on this story. But it's interesting timing, given what we've discussed in the last few days about Huawei's Mate 60 Pro. I would also point out, John, that the European Union published its gatekeepers list under the new digital services law that we were expecting. As expected, the Apple App Store was listed under it, but interesting that iMessage may be exempt, and the EU is probing that. So that may also be a factor as Apple shares are down 0.9% now.
Let's stay on China, Red. Does this raise questions about the new iPhone being launched in the next week or so?
Yeah, I mean, China is still a critically important end market for Apple. It is its biggest international or overseas market beyond the United States. You and I always discuss, following the launch of a new iPhone generation, what the big drivers are of it, and the Chinese middle class is always a part of the conversation that you and I have. That said, you know, I'll be at Wanderlust on September 12th next week. I think there's high anticipation that the hardware upgrades to this generation iPhone are substantive enough that they will do well broadly. And despite all the geopolitics and headlines, you know, Apple, remember, was quite bullish on their performance in China in the quarter just gone. While the US smartphone market saw contraction, China grew.
Ed, thank you, mate. The stock is down by about 1%, 5 minutes into the session, pulling back just a touch here by 0.4% on the S&P 500. On the Nasdaq, down a similar amount. We're negative by 0.37% on the Nasdaq Composite. Turning to the food sector, Albertsons rising after a Bloomberg scoop that the company, along with Kroger, is selling stores to C&S wholesale grocers and SoftBank to help with their $25 billion merger. Katie Greifeld has the story. Hey, Katie.
Hey, John. Yeah, Albertsons currently up about 1.8% on the heels of that Bloomberg scoop that C&S, with, of course, backing from SoftBank, is in talks to buy most or all of the grocery stores that Kroger and Albertsons are looking to offload here. That's according to people familiar with the matter. So rewind here. Remember that Kroger agreed to buy Albertson in that $25 billion deal last October. The end product, of course, would be a U.S. grocery giant with nearly 5,000 stores. And at the time, to soothe those antitrust concerns, the company said that they would sell up to 375 stores, which brings us, of course, to today. And it's not clear so far how many stores C&S would be acquiring or how much they would pay for them. But according to this Bloomberg scoop, that deal could be announced as soon as this week, John. So watch this space.
Stock is up 1.6%. Katie, thanks for that. Let's turn to earnings. Roku raising its third quarter revenue forecast and cutting 10% of its workforce. We determined to implement additional measures to bring down operating expenses by consolidating office spaces, slowing headcount, and limiting new hires. Isabel Lee has more. Hey, Isabel.
Hey, John. Investors are definitely liking that news because the stock is up around 14% for today. And the company also raised its guidance to between 835 to 875 from 815. So that's a massive increase. And Roku is among the tech and media companies that have earlier this year faced prospects of weakening sales as advertising pulls back. And the company last year warned its investors of a tough economy ahead. In March, it also cut back some 6% of its workforce. And this is the second time this year. But because of this recent update, it seems like it's going to be good news for the stock moving forward. We have Bloomberg Intelligence saying the outlook suggests revenue gains are re-accelerating and the job cuts should help overall profitability. And we have Piper Sandler, for its part, raising its price target to 90 from 70, John.
The stock likes it, up almost 14% there. Isabel, thank you for that. Isabel Lee there on Roku. That stock higher to 95.23. The broader market looks like this. 8 minutes into the session, we're negative by, let's call it 0.4%. Yesterday, more price action in the bond market to pay attention to. Yields higher by 16 basis points over the previous 2 days. Yields this morning on a 10-year lower by, let's say, a basis point or two to 4.24. Plenty of blame to go around, some for the commodity market, some for this. September kicking off with a flurry of new debt deals. At least 40 businesses tapping the high-grade debt market on Tuesday alone, with U.S. companies pricing more than $36 billion in new bonds, marking the busiest session of the year so far. BlackRock's Amanda Lynham writing, quote, a key implication of the higher for longer interest rate environment that we expect is an increase in performance dispersion across the corporate credit markets. I'm pleased to say that Amanda Lynham joins us now for more. Amanda, let's start with what's happening with supply currently. Are you expecting more of the same through the month of September?
Good morning, Jonathan. Thank you for having me. Yes, September is historically an exceptionally busy month for primary market supply. Over the past 5 years, it's actually been the busiest month in the U.S. high yield market. And in IG, it's also one of the busiest alongside March and May. So the significant uptick in activity that we've seen, it should be widely expected by bond market participants that have played in this market for a bit. It's just historically the seasonal pattern. I think there are two things, though, that are really important to watch. One is arguably for the high yield market, this is a larger test because we've been coming off of 2022 and year to date, which has been so low from a supply perspective. So it will be notable to see how the high yield market digests the wave of new issue activity that we expect for refinancing. You had noted that this so far this week, while early, has been dominated by investment grade. And so I do think watching that high yield market, and we've seen some announcements this morning, how that flows through the rest of the month will be critical. And then second, you've been talking about it all morning in terms of, is the primary market activity the reason why there's been a sell-off in Treasury yields? And certainly there is a link in terms of, and this is mostly an investment grade phenomenon, if investors are buying a new issue and they wish to hedge the interest rate component, they will sell a maturity of the equivalent, or they will sell a Treasury of the equivalent maturity to kind of hedge out that interest rate risk and isolate the spreads. I think the issue, though, is that the activity we saw in the U.S. IG market so far this week has been heavily skewed to the front end. And I don't think in general that we can attribute it primarily to what's going on in the primary corporate credit market. I think there are enough cross currents, as we've all been following, to really attribute the volatility in the Treasury market to other things outside of corporate supply. But certainly there is a link. I just think that where the issuance has been focused predominantly in the front end, predominantly in single A rated IG issuers, I don't think that we can draw that link completely.
Well, there's two ways of looking at this. Either the people in the Treasury market weren't paying attention to the supply that was coming through, or, Amanda, there's other things, and you've pointed to those other things. So let's talk about it. Those other things, what are the other things you think we should be focused on?
Well, certainly the higher for longer narrative, we can't seem to close the door on that completely. And I think that's probably appropriate. The rally in commodities and crude in particular in recent days has kind of added further fuel to that. We've seen certainly announcements from certain sectors in terms of the potential impact to margins and the bottom line. And I think in some ways we can't really dismiss that narrative that the Fed will need to remain in restrictive territory for quite some time. And certainly whether there's one or two more tweaking hikes from here, I don't think can be completely ruled out. And so that does lend itself to pressure in the Treasury market specifically as kind of the market adjusts to what is a higher for longer cost of capital environment. Now, as it relates to corporate credit, I think really it's all about dispersion. And so we think that higher for longer cost of capital environment will drive dispersion across asset classes. So whether that's public versus private credit, fixed versus floating, if you think about high yield versus leveraged loans, as well as sectors. So sectors with strong pricing power. Are you a commodity purchaser or are you a commodity producer? Arguably, those are kind of really important factors in this current environment. And then certainly at the issuer level, are you aggressive with your capital management structure? Have you been paying down debt? If you're doing M&A, are you funding that with equity or cash? All of those things will add up to success or not on a relative basis on how sectors and companies can navigate this environment.
Amanda, let's just stay on the energy component of that. The winners and losers of $90 crude. Right now, Brent is back through that level. For WTI, it's 9 days of gains. Incidentally, longest daily winning streak potentially going back to January of 2019. Now, Amanda, years ago, we used to talk about the high yield sector being very sensitive to energy. Just how energy sensitive is high yield now versus where it was, say, 5 years ago?
Sure. So to frame this, energy has probably been one of the more bondholder friendly sectors in the high yield market over the past few years because those companies have been really diligent in previous years about paying down debt, specifically coming out of the pandemic. So the sector in both high yield and IG, for that matter, trades tight to the overall index. In terms of the sensitivity, when you're up at levels where we are in crude, so I would say really anywhere north of 50 dollars a barrel, and we're clearly well above that now, the sensitivity flow through to high yield isn't as extreme as you might think because you're so far above the break even that the incremental cash flow to these companies, it's not going to make or break them in terms of a fortune perspective. And so really it boils down to, we know they have the ability to do bondholder friendly balance sheet repair, but do they have the willingness? So it's less about the price of crude at that point and more about what is the management philosophy on the balance sheet. I think for corporate credit investors, this is going to reignite this debate about input costs, margin pressures. We've gone through this to varying degrees over the past few years about, again, are you on the commodity purchasing side of things or are you on the commodity producing side of things? And those have different fortunes associated with them. And I think that's really going to drive the dispersion. But, energy is already at this point priced pretty tight relative to the broader markets. I think also the last time I was speaking with you, we had talked a bit about financials. And I think, this kind of also isolates some of the kind of unique capabilities of the financial sector in not being as exposed to input costs, not being as exposed to some extent on wage pressures and labor costs and freight and logistics. Those are different dynamics and conversations that we're having with investors. And if you looked at, say, just isolating U.S. investment grade, you look at financials and bank spreads relative to industrials, they're still hovering at levels outside of the March regional bank disruption. We're hovering at levels that we really haven't seen since 2012. And so that's a sector that I think is really coming back into focus for investors in terms of if other non-financial sectors are dealing with cross currents, whether they're higher input costs or wage costs, are there other places to look to deploy capital?
I often say this whenever we talk, but Amanda Lynham, that was a clinic. Amanda Lynham there of BlackRock. Amanda, thank you. Coming up, crude on a 9-day winning streak.
The potential for ups and downs and roller coasters on gas prices is impactful in the day-to-day, but we're not going to vote for another 18 months or so. So that gives the Biden administration quite a bit of time.
Team coverage up next.
At the very earliest, you're talking about March, April of next year before voters start locking in their opinions of the economy. So right now, the potential for ups and downs and roller coasters on gas prices is impactful in the day-to-day, but we're not going to vote for another 18 months or so. So that gives the Biden administration quite a bit of time.
Henry Trace there of Vader Partners weighing in on voters and gas prices. The Saudis and Russia are extending oil cuts, doing Biden no favors at the pump. The White House weighing in.
What was announced today was a continuation of an existing policy, not a new set of cuts. The most important thing that the president is focused on is just trying to do everything within his toolkit to be able to get lower prices for consumers at the gas pump.
Airlines also feeling the pressure. United boosting its average price per gallon guidance for the quarter, writing this. Since mid-July 2023, jet fuel prices have climbed over 20%. As a result, the company's third quarter 23 all-in fuel price is now expected to be between $2.95 to $3.05 per gallon. Team coverage starts right now with Bloomberg's Anne-Marie and Will Kennedy. Will, let's start with you. Will, how rare is it to see gasoline prices where they are at this time of the year?
Yeah, I mean, they're very high on a seasonal basis, not far from being the highest seasonally since 2012. So it is starting to cause pain at the pump. And, you know, we saw from your chart there that we're not far off from $4 a gallon on average throughout the US, which, as we know, is often seen as a point where people really start to feel the impact of higher gasoline prices.
Well, it's odd this is happening at a time where people are talking down the prospects for the Chinese economy, and crude output in America is up close to all-time highs. Well, can you explain that?
Well, I think we need to take a nuanced view of Chinese oil demand and the Chinese oil economy. We've been talking to a lot of traders in Singapore this week, the team has, where there's a big gathering of oil executives, and they say that actually there are parts of the Chinese oil demand picture looks very strong. The gasoline demand has been flying over the summer as people take the chance in the post-COVID world to move around again. Jet fuel demand likewise has been on the up. And so China's crude imports have been pretty healthy. And that's on top of a world where demand has been strong throughout the world. Yes, there have been supply increases as well in the US, as you mentioned, in Venezuela, Iran. But I think a lot of those have played out. So when put together with the cuts, the extension of the Saudi cuts, I think a lot of traders are seeing quite a sort of bullish brew here.
Anne-Marie, how do you think the White House manages this message, particularly with crude output in America at 12.8 million barrels a day?
Well, it's difficult, Jonathan, because obviously we're talking about the gas price, the oil prices we see on our terminal, WTI and Brent. But when that trickles down across the refining process, that means higher gasoline prices on the side of the road. And we already know what this means for the administration. They're going to have to deal with this narrative about a tax on consumers. And already this administration has gotten poor remarks by how they were handling inflation, how they're handling the economy. When you see higher gasoline prices, that is only going to fuel that narrative. And Jake Sullivan yesterday said this is the ultimate metric of success, keeping gasoline prices down for the administration. Well, as Will just said, we're seeing on a seasonal level, this is the highest it's been in decades. So this is going to be a difficult one for them to try to tame down, especially as they tout Bidenomics ahead of next year's election.
Very difficult, super tough. Will Kennedy, Anne-Marie, to the two of you, thank you. For the broader market right now, 23 minutes into the session, equities pulling back just a touch. We're down 0.25% on the S&P. Similar move on the NASDAQ. In the bond market, yields basically unchanged, down a basis point or so on a 10-year. The 10-year right now about 4.25. Coming up next, your trading diary. 2 days of losses potentially on the S&P 500. We're down here by about 1/3 of 1%. That's the price action. Let's get to the trading diary. The week ahead looks like this. Fed releases its beige book at 2 p.m. Eastern Time. President Biden speaks at 2:15 this afternoon. Thursday, more Fed speak. Harker, Goolsbee, Williams, Bostic and Bowman. And another round of jobless claims. And on Saturday, the G20 summit begins. From New York City, that does it for me. Thank you for choosing Bloomberg TV. Good luck, of course, for the rest of the trading day. This was the countdown to the open. This is Bloomberg.